Happy Tuesday, everybody. I hope you had a great long weekend. If you celebrated Christmas, I hope it was joyous. Due to the holiday and the market being closed yesterday, today is December 27, 2022, and this is your Tuesday market update. The last week of the year will be a busy one, so let's jump right in, review last week, and preview this week. I read this week that there is a new word in the Collins Dictionary for 2022, permacrisis. That is the dizzying sense of lurching from one unprecedented event to another. Pretty much explains the past few years. So last Monday, stocks started out slightly higher, but that was no more than a weak bounce from the previous week's action. The gains did not last long, and by mid-morning, the markets were all in the red. Rising global yields, housing data, and more soft eco data were the culprits. Taking all of that into account, the main reason was really the calendar. The CPI from the past week was the holdout to hope to spark the Santa Claus rally, but the opposite happened. As I've mentioned, there are not a lot of catalyst news items left this year, so tax loss selling and no positive news leads to a poor market. The negative calls from Morgan Stanley was joined by Goldman Sachs, but as I mentioned last week, there are also positive calls too. Remember, Jeremy Siegel thinks the Fed's on a different planet. Oil is bouncing around, the dollar is dropping to new recent lows, down 10% since September. Thus, commodities are rising. Overall, not huge numbers, but still in the red. The Dow was down 0.5%, the S&P down almost 1%, and the NASDAQ down 1.5%. Tuesday brought a surprise from Japan that rattled the credit markets until they got over the surprise, like someone yelling, boo. You may jump back, you have to catch your breath, but then you go about your day. Stocks dropped early as the Bank of Japan expanded the limit they would let their 10-year float, and that was the 10-year bond float, and that was a mild relief rally on stocks. Oil bumped up again, and nat gas got clobbered. Reasons for that was the EU price cap and also less intense winter weather. You'll have to convince me of that one. As most of the country dealt with the bomb cyclone this past weekend, overall, for the day, the Dow was up 0.25%, the S&P up 0.1%, and the NASDAQ was flat on the day. There was some positive news after the close on Tuesday as Nike and FedEx actually made people feel good. Inventories getting better at Nike and cost cutting at FedEx. This was good news for a market that was thinking there would only be bad news in the earnings department. Stocks were higher at the open on Wednesday thanks to those two. Add in the Conference Board, inflation expectations fell to the lowest level since September of 2021. Overall, the markets liked the news and started to sniff out Santa. Dow was up more than 1.5%. S&P and NASDAQ were both up about 1.5%. Thursday brought the shift back to the other side of the boat. Micron warnings and news, labor news, better than expected, which is not what the Fed wants. And add in a major hedge fund named David Tepper warning and talking about betting against the market. The markets were back on the downside, pretty much giving back what they gained on Wednesday. The Dow was down 1%, S&P down 1.5%, and the NASDAQ down 2.25%. Friday began with the Fed's favorite PCE, personal consumption expenditures. They came in slightly higher than expected. Inflation is still sticking around, not what the Fed and in turn the markets want to hear. University of Michigan consumer sentiment was higher than expected. Inflation expectations are coming down. Before the day was over, the Dow was up 0.5%, the S&P was up a bit over 0.5%, and the NASDAQ was up about 0.25%. For the week, still lower on the S&P and the NASDAQ, but the Dow was up slightly on the week. With 1 week left, December has been brutal. The Dow is down 4% on the month, S&P down 5.8%, the NASDAQ down 8.5% for the month. Can we turn around in the 4 trading days? Crazier things have happened. This year is a big one for 2% daily moves, 23 positive 2% days and 22 negative 2% days, the most since 2008, 2009. This week, as we know, it'll be a short week. Excuse me. We do have some housing data and PMI to get a read on U.S. manufacturing. Not much else. You can count how many times the press talks about and writes about the Santa Claus rally. It'll be a lot. December has ground to make up. According to the Stock Traders Almanac, since 1950, the last 5 trading days of the year and the first 2 of next year have brought a 1.3% positive return on the S&P. We'll have to see if that happens this year. We'll start to watch for earnings again starting January 13. With banks, rest assured we'll hear from a lot of Fed heads when they return to the camera after the first of the year. For now, let's finish this strong. Call me with any questions. Let's look forward to what everyone hopes will be a better 2023. If you don't catch the Friday video, let me wish you a Happy New Year now. If you can, come back on Friday and we'll wrap up the year with some planning ideas for early January. Have a great week.